Hi everyone, welcome to the RBA's pre-exam webinar for economic students. Really glad you could join us today and we hope you find this webinar useful. To begin, I wanted to acknowledge the traditional owners of the land on which we meet today. For me, that's the Gadigal people of the Eora Nation here in Sydney. Pay my respect to elders past and present and extend that respect to any Aboriginal and Torres Strait Islander people joining us today. So my name is Emma Chow and I'm an economist working here at the Reserve Bank of Australia. I've been here for 5 years now, working in different teams, looking at the labour markets, financial markets, and now in the education team. So really excited to do this pre-exam webinar for you today. I remember around a bit over 10 years ago when I was preparing for my Year 12 economics exam. And I know the feeling can be a bit overwhelming, knowing that there's all these exams coming up, but we hope today this webinar will help you to feel a little bit more prepared and more confident for that economics exam. So I'll pass it on to Jack, who's also going to be presenting and who can talk a little bit about himself.
Thanks, Emma. By way of introduction, my name is Jack Harden, and I've been at the Reserve Bank for around 6 months now. Prior to joining the bank, I spent 3 years at Commonwealth Treasury, where I worked in the macroeconomic forecasting area. So that's a bit about my background. But back to the presentation. So here is what we're going to cover over the next hour or so. So to start, Emma will walk you through what's happened in the Australian economy over the past few years and how the Reserve Bank has responded with monetary policy. Next, I will spend a bit of time talking about trade, including the impact of tariffs on the Australian economy. And then at the end, we'll wrap up with a Q&A session. So you can pop your questions into the Zoom Q&A box at any stage throughout the presentation. I can actually see a few questions already asking about whether this session will be recorded, and the answer is yes, we will be recording this presentation, so you can view it at the end of the session at a later date. So yeah, we'll try our best to get through as many questions as possible when we do get to the Q&A session. Unfortunately, we won't be able to cover specific exam techniques or specific exam questions, and this is because the syllabus and exam format is quite different across each state and territory. But we're confident that a solid understanding of recent economic conditions will be valuable for everyone, no matter what you're studying. So I will now hand back to Emma, who will kick us off.
Thanks, Jack. All right, so in the past few years, there's been a lot that's been happening in the economy, but we've also seen large shifts in monetary policy. So for my section, I'll be unpacking what's happened in the economy in the last few years, and I'll also give you some key statistics that you might find helpful. So before we get to that, I wanted to start with a quick refresher of what monetary policy is. So there's going to be 3 rapid-fire questions. So the first question is, the RBA only considers inflation when making monetary policy decisions. True or false? Well, I hope you answered false. So the RBA, we have a dual mandate. So there's 2 objectives we care about. The first one is price stability, which means maintaining low and stable inflation. And the second objective is full employment. So ensuring that there's enough jobs for people who want to work and are available to work. And then the overarching objective above these 2 is to promote the economic prosperity and welfare of the Australian people. All right, question 2. Reducing inflation means prices will fall. True or false? Answer is false. So remember what inflation means. So inflation is an increase in the prices of goods and services over time. So it's about the change. So when inflation is reduced, it means that prices are still increasing, but just at a slower rate than before. So if if prices were to actually fall, this would need deflation, which is actually a negative inflation rate. So the answer here is false. All right, last question. why does the RBA aim to keep inflation between 2 to 3% each year? You might otherwise know this as the RBA's inflation target band. So the answer is that, we wanted to keep inflation within this band because we want to avoid the cost to the economy from inflation being too high or too low. If inflation is too high, prices are rising too quickly and people's purchasing power is reduced. And this can hurt households, especially if prices are rising faster than the incomes that people are earning. It's also inflation also makes it harder for business to plan. And on the flip side, if inflation is too low, this is also not great for the economy because it signals weak demand in the economy. If you know that prices will be lower in the future, you might delay purchasing that bag or those sneakers. And imagine that happening to everyone. So there's a delayed in consumption. Businesses may not need to hire so many workers, and there's sort of this effect of continuing low demand in the economy. So that's why the RBA has this inflation target band to keep it between 2 to 3%. All right, so that was a quick refresher. Now we'll go into what's actually been happening in the economy. So I'll start off with giving a high-level summary or a timeline of the key events in the Australian economy over the last 5 years. So let's start with 2020. That's when the COVID-19 pandemic hit. The economy slowed sharply. So FYI, I'll be going through each of these in more detail in the next slides, but yeah, just going through a high-level overview for now. Pandemic hit, the economy slowed dramatically. We saw GDP fell by 7% in the June quarter of 2020. At the same time, unemployment rose quickly, up to a peak of 7.4% in June. And in response, both the Australian government and the RBA implemented stimulus measures to really help support the economy and jobs. Now, a year later, as the economy gradually reopened, there was a lot of pent-up demand for goods and services. And at the same time, there were supply constraints as global supply chains couldn't keep up with all this demand. And so a combination of all these factors meant that inflation started to rise. Now, inflation kept increasing and it reached a peak of 7.8% at the end of 2022. The labour market was also very strong at this point, with unemployment rates falling to 3.4%, which was the lowest level in several decades. And in response to high inflation and the strong labour market, the RBA started to increase interest rates from the middle of 2022 all the way to the end of 2023, where the cash rate rose to 4.35%. And more recently, the combination of interest rates being raised to that high level plus high inflation meant that households and businesses start to cut down on their spending, leading economic growth to slow down. And with that, we've seen inflation coming down from those high levels and a slight easing in the labour market. And so all of this brings us to this year. We have underlying inflation back in the target range of 2 to 3%. The RBA has also lowered the cash rate 3 times. It's currently at 3.6%. And of course, there's been so much global uncertainty this year with new trade policies in the US. So that's really added a lot of complexity to policy making, which Jack will go through in a bit more detail later. So I think this already shows that there's been so much that's happened in the last 5 years. And I think it's a really interesting time to be studying economics. All right, so I'll go through each of these in a bit more detail. But first, let's take a step back to see how we got to where we are today. Starting with the COVID shock in 2020. So as you will probably all remember really well, we went into lockdown like the rest of the world. Schools and workplaces closed. People were stayed at home to help stop the spread of the virus. And of course, an iconic memory is that the missing toilet paper in supermarkets. But looking at the economy, it really slowed dramatically. On the supply side, many businesses had to reduce their operations or had to shut down completely because of lockdowns and the restrictions on going out. And on the demand side, people weren't able to spend money on certain goods and services like travel or dining out. And also, there was a lot of uncertainty about how the economy would look like. So people and businesses were less likely to want to spend or invest their money. So the combination of this supply and demand shock meant there was a large contraction of the Australian economy. So looking at Australia's gross domestic product, or GDP, in this chart, we can see that it fell by 7% in the June quarter of 2020. And to put that in context, this was the largest contraction of the Australian economy since the end of the Second World War. So, over 50 years ago. And at the same time, we saw a quick rise in unemployment, reaching 7.4% in June 2020. And it was really those industries that had a lot of human-to-human contact that were affected the most. So think jobs in hospitality, fast food chains, retail, tourism, and entertainment. So in response to the pandemic, there were substantial fiscal and monetary policy support that were introduced. The goal was to support aggregate demand and employment, get people to keep buying, hiring workers, and investing. And so for the RBA, this meant they lowered the cash rate in that year. So they first lowered the cash rate twice in March 2020, as you can see in this chart. And then in November 2020, they lowered it further to 0.1%. So really bring it down to near zero levels. Having lower cash rates mean there are also lower interest rates, and this makes borrowing cheaper, encouraging people to spend and to invest. This was a time when the RBA also used unconventional tools for the first time. So we have an explainer on the RBA website that goes through all the different tools in more depth. But for example, this included providing low-cost funding to banks. The Australian government also rolled out large fiscal stimulus packages like the JobKeeper program. Now, fast forward to 2021 and things changed pretty quickly. So as lockdowns ended and borders reopened, people were keen to get back to normal life. At the time, I remember going out a lot to see my friends, going back to playing badminton, wanting to travel. So there was a lot of pent-up demand for goods and services. And all the stimulus measures that I just mentioned earlier also helped support this demand, as it meant people had money to spend. But the problem was, at the same time, supply couldn't keep up. So there were big disruptions to global supply chains. You might remember at the time, either you or your family might maybe experiencing delays in getting laptops or cars. So this was due to those disruptions. And also in 2022, the Russia's invasion of Ukraine caused global energy prices to spike. So the combination of strong demand and these supply disruptions meant that prices started to rise really quickly. And looking at this chart of inflation, we can see that inflation rose from around 3.8% in the middle of 2021 all the way to 7.8% in the December quarter of 2022. And this was the highest level of inflation that we've had for around 30 years. And we saw inflation across a wide range of goods and services. So people really felt it everywhere, whether that was grocery prices, petrol, the cost of building a new home or renting, or dining out and entertainment. Now, while inflation was going up over this period of time, the labor market was actually doing really well at the same time. So when you think about it, there's a lot of demand for goods and services. And so naturally, businesses also needed more workers. So if we look at this chart of the unemployment rates, you can see that quick decline over that period, 2021, and then the end of around middle of 2022, so July, the unemployment rates fell to 3.4%. And again, this is a really low number. In fact, it's the lowest rate of unemployment that we've had in over 50 years. So this meant that many people got jobs. The RBA looks at more indicators about the labour market in addition to the unemployment rate. So we also look at employment growth, which was very strong at the time. Underemployment, so that's referring to those who are employed but want to work more hours. That was also really low, meaning that a lot of people got to work those extra hours that they wanted. So overall, the labour market was doing really well. In fact, probably a little bit too well. So economists would say that the labour market was tight relative to full employment, which in simple terms, it just means that firms' demand for workers exceeded actual availability of workers at the time. And so that's consistent with stories of labour shortages that we heard around this time, particularly in hospitality and healthcare construction. So with inflation rising and the labour market being so strong, the RBA board began to increase interest rates. So they raised it to 0.35% in May 2022, and then another 12 times to 4.35% in November 2023. The goal was to, slow down growth in demand to reduce inflation. But here was the challenge. There's a trade-off, right? If we slow down demand growth, there's a risk this could also weaken the job market. So the RBA board had to carefully consider how much to raise rates to slow inflation without causing a big rise in unemployment. And so the RBA board chose a measured approach. They raised the cash rate quickly at first and then held it steady for over a year. The reason being that we have a dual mandate, we want to bring inflation down, but also want to preserve as many gains in the labour market as possible. So how has this all played out so far? Which is what we're going through right now. So with high interest rates, but also with high inflation, this has helped to slow demand growth in the economy in the last few years or so. With high inflation, people have started to cut back on their spending. So this lower demand growth was important because remember, a lot of the reason why inflation increased so quickly at first was because demand was increasing faster than supply. And so with high interest rates, this was important in slowing down demand growth so that demand and supply are in better balance, and that will help bring inflation down. So looking at this chart, the most recent observation we have for GDP growth was for the June quarter of this year. So GDP increased by 1.8% over the years of the June quarter. You can see this is, still over history, a bit low, but it's picked up a little in recent quarters, particularly driven by recovery in the private sector, so households. Now, looking at inflation, there's been really good progress with inflation, coming down back within the 2 to 3% target range. So the RBA looks at both headline inflation and underlying inflation. So headline inflation looks at overall prices, and underlying inflation would exclude some more volatile items in the CPI basket. So this could be food or fuel. So most current data that we have for inflation would be for the June quarter of this year. So underlying inflation has declined to 2.7%, whereas headline inflation fell to 2.1%. And headline inflation has been a little bit lower because it's been affected by temporary cost of living relief measures. But overall, it's really great to see inflation coming down and back within target. And here's the other good news. So even as inflation fell, the labour market overall still remained pretty resilient. So looking at the unemployment rates, it's increased a little since that really low level that I mentioned a few slides ago, and it's currently at 4.2% in August 2025. So unemployment's increased a little, but overall, compared to history, it still remains pretty low. And we're still seeing that employment growth remaining solid and the participation rates. So that's looking at the working age population in Australia, how many of those people are working or wanting to find a job. That participation rate is still near record high levels at 66.8% in August. So overall, we're seeing that inflation is coming down, the economy is growing more slowly, but still steadily, and people are still being able to find jobs. One important thing to keep in mind, though, is that there's a lot of uncertainty, especially in the global economy right now. You will probably know why. There's been new tariffs imposed by the United States on the rest of the world. So a tariff is a tax on imported goods. Jack will spend more time discussing this in more detail, so I'll leave it to Jack. But just wanted to note that this has been a big source of uncertainty, and that's something that the RBA is looking at closely. All right, so taking this all together, what has the RBA decided to do this year? So the RBA board decided to reduce the cash rate to 4.1% in February, and then they lowered it again in May and August to 3.6%. The main reasons are that we've seen good progress in inflation continuing to come down and is now back within our target range of 2 to 3%. At the same time, labour market conditions have eased slightly, but still remain pretty resilient overall. And we've seen that with unemployment rates having increased a little bit, but still overall being quite low. And the RBA's forecast of the economy suggests that underlying inflation will fall a little bit further to around the midpoint of the 2 to 3% target range, which is where we want it to be. And so finally, looking at the most recent RBA board meeting at the end of September, the board decided to keep the cash rates unchanged at 3.6%. So there were a bit of recent inflation data. That's for the monthly series, whereas the quarterly series is our preferred series. But the monthly inflation data suggested that inflation in September may be a little bit higher than what we had expected, and could suggest that inflation may be a little bit more persistent in some areas. At the same time, labour markets continue to be broadly steady, but we're also aware that the outlook is highly uncertain, especially with all the changes happening in the global economy. And so the RBA board judged that it was appropriate to remain cautious, and it would update its view of the outlook of the economy as we get more data. And end of the day, the board is committed to deliver its mandate of price stability and full employment. So that's a wrap up on our look at the economy over the last few years. Again, as I mentioned, there's been so much that's happened in the last 5 years, and I think it's given some really great real world examples of the economic concepts and ideas you learn in class. And it's a reminder that it's not just theory, it's actually happening all around us. So I hope that was useful, and I'll pass it on now to Jack to talk about trade and tariffs.
Thanks, Emma. So next, we will talk about trade, which has been a hot topic in the news this year. So what will we cover? Well, first, we'll do a recap on tariffs. So things like what is a tariff and why are they relevant this year? And then we'll look at how tariffs impact trade and the Australian economy with a focus on economic activity, so GDP, and then also inflation as well. So let's start with the recap on tariffs. What is a tariff? So a tariff is a tax placed on goods imported from another country, and this makes those imported goods more expensive. And we can demonstrate this through a really simple example. So I play a lot of soccer, and I have done for many years. And for those many years, I've always purchased my boots from the United States. Now, why do I do this? Well, I do this because it gives me more choice. So the United States generally have more brands to choose from, and they also have more colors too. And I like to match the soccer boot with the color of the team that I'm playing for. So, with this in mind, suppose Australia imposed a tariff of 10% on football boots. What does this mean, and how does it affect me? Well, quite simply, this means I would have to pay 10% more on any boots that I buy from overseas. So if the football boots cost me $200 before the tariff, then they will now cost me $220 after the tariff. And so I'll have to make a decision. Do I continue purchasing these boots from the United States and pay the extra 10%? Or do I start looking for domestically produced boots instead, where I might be able to get a better deal? So that's the basic idea behind tariffs. So why are they relevant? Well, in 2025, so this year, the US imposed tariffs on the rest of the world. I'm sure you heard all about that in your class, but also in the news as well. So most countries received a tariff rate between 15 and 20%. However, in Australia, we received a slightly lower tariff rate of 10%. Now, one really interesting thing about these tariffs is what happened between the United States and China. So we'll quickly explore that in a little bit of detail. So as you may have heard, the US and China actually entered a trade war earlier this year. So prior to the US tariff announcements in April, the US had a 20% tariff on China, and China had no broad-based tariffs on the US. They did, however, have some selective tariffs on energy and agriculture products, but for simplicity, we'll say that the tariff rate was 0%. So what happened? Well, in April, when the US imposed tariffs on everyone, they increased the tariff rate on China to 54%. China weren't too happy about this, and so they retaliated with a tariff of their own, and this tariff was 34%. So the US put a tariff on China. This hurts China because remember, a tariff is a tax on imported goods. It makes imported goods more expensive. Therefore, US consumers are less likely to purchase goods from China. China didn't like this. They retaliated with a tariff of their own. But the US didn't like this retaliation, and so they hit back with another tariff, increasing the tariff rate to 104%. And once again, China responded with their own tariff of 84%. Now, it didn't end here. There was actually one more increase each, where the US increased to 145%, and then China responded once more with a tariff of 125%. Now, these are huge numbers, right? So where are they now? What is the current tariff rate? Well, the US and China decided to enter a tariff truce, which goes until November. So this truce allows both countries a bit of time to negotiate and come up with some sort of long-term solution that benefits both. So as it stands right now, before this tariff truce ends, we have a 30% tariff that the US has put on Chinese imports, and then we have a 10% tariff that China has put on US imports. So 30% and 10% are the current rates. So that's a bit about tariffs, but how do tariffs actually impact trade and the Australian economy? We'll start with GDP, and then we'll look at inflation. So first up, the impact of US tariffs on economic activity in Australia. Let's answer this question with a concept you may have heard of before in the classroom, and this is aggregate demand. So recall that aggregate demand refers to the total spending in an economy. And it's made up of a bunch of subcomponents, which I've listed here, C, I, G, and X minus M. Now, I'm sure you know this, but just in case, we've got C, consumption, and this might include things like groceries or going to the cafe for lunch. We have I, investment, and this might include machinery and equipment, or perhaps a business is purchasing a new office building or a factory. We have G for government, and this includes things like schools, hospitals, as well as welfare payments. And then we have X minus M, or our net exports. And this is what we sell overseas and what we purchase from overseas, and that's captured here. So what impact do tariffs have on aggregate demand? Well, tariffs make US imports more expensive, and they also increase global uncertainty. So let's focus on the first one here. Tariffs make imported goods more expensive. So what does this mean? Well, consumers are now less likely to purchase goods from overseas. So this means that the tariffs reduce the demand for Australian exports because US consumers are less likely to purchase our goods in Australia. So if we have a decrease in X, then this means we're going to have a decrease in aggregate demand. Jumping now to the second point, increased global uncertainty. When households and businesses aren't sure what's going to happen, they might play it safe and decide to save their money instead of spending it. And this could lead to slower growth in both consumption and investment. And this would also slow economic activity. So once again, we see a decrease in the C and I, and this means AD, or aggregate demand, is going to decrease. So to summarize, US tariffs make US imports more expensive. They also increase global uncertainty, and this will lower aggregate demand and reduce activity in Australia. So GDP will go down. What about the impact of US tariffs on inflation in Australia? Now, this one is actually a little bit complicated and can be a bit confusing, so bear with me here. We'll go through it slowly. There's actually two effects, and they're working in opposite directions. So firstly, we have the demand effect. So we just went through aggregate demand. Tariffs will make US imports more expensive and increase global uncertainty, and therefore lower. This means there will be lower aggregate demand. So this is the demand effect. We can illustrate this graphically to look at the impact on prices. So here we have an aggregate demand, aggregate supply curve represented in a graph. The focus is these blue lines, aggregate demand 1 and aggregate demand 2. As we said before, tariffs will reduce aggregate demand, and this means aggregate demand will shift to the left. So we have that here, and that means we have downward pressure on prices. And so this is looking at the intersection between the aggregate supply curve and the new aggregate demand 2 curve. So coming back, we have the impact of tariffs on aggregate demand, and we can say that the demand effect is equal to downward pressure on prices. So this is the first effect. However, we also have a supply effect. So quickly, a definition of aggregate supply. This refers to the total amount of goods and services the economy can produce. But the question is now, what impact do tariffs have on aggregate supply? Well, tariffs disrupt global supply chains, which makes it harder and more expensive for businesses to get parts from overseas. It can also lower productivity and raise the cost of production. All of this means that the economy can't produce as much as it could before. And so this means there is less aggregate supply. Once again, we can illustrate this through a graph. So here the focus is on the red line, so aggregate supply 1 and aggregate supply 2. Once again, we said that tariffs will reduce aggregate supply, and this is represented by a leftward shift of the aggregate supply curve. So moving from aggregate supply 1 across to aggregate supply 2. What impact does this have on prices? Well, we can see that it puts a bit of upward pressure on prices. So coming back, we have the demand effect equal to downward pressure on prices. But now we have this supply effect, which is equal to upward pressure on prices. So in summary, lower aggregate demand will put downward pressure on inflation, and lower aggregate supply will put upward pressure on inflation. But what is the overall effect on inflation? Well, this depends on whether you think the demand effect will be stronger or whether you think the supply effect will be stronger. Which one will be the strongest? And at the bank, we think the demand effect will be stronger. So overall, we expect that these tariff-related effects will put a bit of downward pressure on prices. So that's the summary of trade and tariffs. There's been a lot happening this year, and I think that concludes the presentation part of this webinar.